Most chart indicators are about analyzing the data that is already there on the price chart. My tools are more about adding additional data. One of the easiest and most powerful ways to do this is to add data from a correlated instrument. So today, we're going to talk about doing this with spread charts. These charts are absolutely essential to understanding certain flows and market moves, and I literally cannot day trade without them. Yet, strangely enough, most platforms don't include them at all. So, of course, I made my own for NinjaTrader, and now they're available to you. And if you're not using NinjaTrader, don't worry, the information that I'm going to go over here will be relevant to everyone, because spread charts really are relevant to every trader, not just those of us trading bonds and the yield curve. And speaking of the yield curve, that is something that we're going to get into in a different video. Today, we're going to be focused more on general information about spreads and how they can help you analyze flows. So let's start by briefly explaining what we're charting here. A spread chart simply charts the difference between two or more different assets. So we can look at two highly correlated instruments and detect the subtle differences between them. One of the most popular spreads we trade in the treasury markets is the difference between the 10-year treasury notes, which I have over here on the right, and the 30-year treasury bond, which I have over here on the left. So these are very, very correlated. You notice each move, they follow each other pretty much move for move, but there actually is a difference. And so if we come over here and we look at the spread chart here down at the bottom, you can see the difference between the 10-year notes and the 30-year bond. And we call this the knob spread. That's notes over bonds. So the 10-year is the front leg and the 30-year is the back leg in the knob spread. Now, these two instruments are sized differently, and so each leg is usually associated with a ratio that we can use to normalize between them. And there is actually a page here on the CME where they list some exchange traded spreads and the ratios between them. So we're looking at the knob spread here again, and the current ratio is 2-to-1. That means 2 10-year notes versus 1 30-year bond. Like I said, though, this is not just a thing in treasuries. For instance, something that I have up on my chart of the S&P 500 is the difference between the S&P 500 and the NASDAQ right here. There's also the crush spread, which is the difference between soybeans, soybean meal, and soybean oil. Or there's the crack spread, the difference between crude oil and the refined products. You can even plot the difference between two highly correlated stocks in the same sector. So like I said, it is a valuable tool to everyone. Now, as I said earlier, I have created spread charts for NinjaTrader. There is a free version that is available in the free suite. There's also a more advanced version that is part of the paid suite. You can download and trial the advanced suite for 2 weeks, and then after that, you need to pay a one-time fee for a lifetime license. So here's the basic free version. Let me go into the indicators. All you have to do is specify the front leg, front ratio, back leg, and back ratio. Also note that for the front leg and back leg, the instruments, you have to specify the expiration of the future that you're going to be looking at. I'll also note that because it's the free version, you can go and look at the code, but there's really not too much there. It's pretty simple. You're just adding the two data series, and then you're calculating the value, which is the front leg times the front ratio minus the back leg times the back ratio. So what are you getting in the paid version? Well, there's 4 major features that we're getting, and some of them were actually quite tricky to do. I think that's probably why a lot of platforms don't include this stuff. It can add a lot of complexity, and other developers would probably charge you like 50 to $100 or more just for the one indicator, but I'm giving it to you as part of a whole suite of indicators for that much. So I definitely think you're getting your money's worth, but here are the different features. Let me switch over to the advanced version of the indicator and we'll go into some of the settings. So the first big thing is that there is auto rollover. So you don't have to specify what month, what the expiration of the contract is going to be. And this is really useful because otherwise, every time that you roll over, you would have to go into the indicator and manually change things, which is a huge pain in the butt. Here, it just uses the expiration of the main chart to determine what the expiration of the spreads that they're going to be using underneath. That is important to note because if you want to do something like add the knob spread to a chart of the S&P 500, they have different expirations. So in that case, you would want to check this user provides month and then add the months in here like this L325, right? You might also want to do that if you were going to look at, say, a calendar spread, like the difference between the ZN 0325 and ZN 0625. Another feature of the advanced spread is that it can handle more than 2 legs. So you can have up to 5 different legs here. So this is used, for instance, in treasuries. There are butterfly spreads that use 3 legs, and that can tell you if the convexity of the yield curve is changing. Super advanced stuff, but this was a very heavily requested feature that I do have a couple of people using. The next big one is that there is candles. So here under chart type, you can switch it between line on close or candles. Candles are particularly important if you want to look at the spread on a higher time frame chart. Here I have 30-minute bars, and it's a lot easier to see what's going on using the candlesticks. Now, this does introduce a little bit of complexity because the high in one instrument might not occur at the same time as the high in the other instrument. So you would have to look inside the bar to know for sure. However, doing so requires the platform to download more data and all this other stuff, all for something that is pretty close most of the time anyways. So that's the last major feature that I have, which is that there is a difference between historical and live bars. So what I've done is I've kept things simple for the historical bars. It assumes that the high of the spread is using the current bar's high from both of the instruments involved in the spread. If you want historical bars with more accuracy, just change the time frame of your main chart to go into a lower time frame. If it's live, we recalculate the spread on every price change. And so the open, high, low, close bars done on live should be perfectly accurate. And if you want to know which bars were recorded live versus ones that were calculated historically, you can use this option in the indicator gray historical bars. Okay, so now that you understand the indicator itself, how do we use it? Well, first of all, it can help us narrow down the catalyst for a move. When we get a move in the underlying instruments, we want to determine what is driving those flows, and we might have multiple theories for what is causing the move. That the spreads did or did not move might help us confirm or reject certain theories. Second, it can help us better interpret the order flow. For the treasuries in particular, a large amount of the volume comes in the form of spread trades. So when there's changes in the spreads, it results in flows that you'll have to discount in order to read the order flow correctly in the individual legs. So say, for instance, we're watching the knob spread and it's going up. What does that mean for the yield curve? Is it steepening or flattening? Well, that's one of those things that is best to just memorize. Like, don't try picturing the yield curve in your head and flipping it around to prices and all that sort of stuff. It's much easier to just memorize this simple rule based on which direction the spread is going. Down is flat, up is steep. The same thing applies for which leg it gets bought and sold. You are buying or selling the front month. So if it is going up, it's steepening, you are buying the front month. If it is going down, it is flattening, you are selling the front month. Once you memorize that, it's a lot easier to kind of figure out in your head what's going on and do your analysis. So back to our scenario, if the line is moving up, that means we're steepening. They will buy the front month ZN and sell the back month ZB. That means that I kind of have to somewhat discount the selling that I see in ZB. That selling is due to spread trades and won't necessarily reflect whether the outrights overall continue trending up or down or not. This scenario is pretty common when we are getting a flight to safety move, and it can really screw beginners up. The treasuries are moving up across the board, then you see selling in ZB or maybe a particularly large offer iceberg in ZB. And the beginner will think, oh, well, maybe the panic is over because I'm starting to see like reversal behavior, only to end up getting completely flattened by what turns into a trend day. See, that selling flow in ZB is coming because we also tend to steepen during flight to safety moves. So that extra selling in ZB is not a reversal, but reflects the flows coming in from spread trades. Now, on the flip side, maybe you're not expecting much that day, and then you start to see a spread flow come in with one instrument buying hard and the other instruments selling hard, watch out, because that is one of the best signs I know of that a big move is coming. Now, again, this kind of analysis can be done with any spread, whether it's treasuries, equity indexes, or any of the other spreads that I mentioned earlier. You just have to understand your particular market and why the two instruments might be affected differently by a particular event. And that's really all there is to it. Now, I'm sure that you might be thinking, oh, yeah, that's all there is to it. That was incredibly complicated. But don't worry about it. It will seem very intimidating and complicated at first because it's a completely new concept. I don't see very many retail traders out there tracking spreads and thinking about this. You probably haven't heard people talk about it or thought much about it yourself, but you will be shocked how quickly you get up to speed when you start watching this in your daily trading. And remember, this is a video, so you can come back and watch it multiple times, and as you do so, new connections will grow in your brain and it will seem like second nature to you before you know it. Of course, this all begs the question, what about trading the spread itself? Well, this isn't super popular in the retail space because of the commissions of multiple legs really add up. So it's something that I feel is really necessary to analyze certain instruments and understand certain moves. It may or may not be worth it to you to actually try and trade it. However, there are some interesting opportunities there, especially now that we have the smaller micro treasury yield futures that are sized for small accounts to swing trade. But that's probably something to discuss in a future video when we're talking more about the yield curve overall and what different types of moves mean. I do want to note, though, that the spreads exhibit their own set of behaviors that differ from the outrights. On higher time frames, we spend most of the time flattening, which is only interrupted by periods of quick steepening during risk-off markets. In other words, the flattener will work most of the time, except for that brief period where it doesn't work, you will get absolutely destroyed. And in those brief periods of steepening, you can make insane amounts of money very quickly on the knob spread. On short time frames, my own backtest suggests that spreads might have more mean reversion in them than other instruments. But that's just what I've discovered for myself so far. The whole reason that these indicators are here is that they are tools so that you can do your own backtesting and research and understand the market on your own. So let me know what you think. If you have any questions about this, you can leave them in the comments, or you can always find me on Discord or during the live streams and ask me directly. Don't forget to check out speculatorseth.com and download both the free and the paid indicator suite for NinjaTrader 8. Remember that the paid indicator suite, you can download and install it risk-free. Try it for 2 weeks. Try putting the spreads on your chart and looking at it for 2 weeks and seeing if it helps you before you end up buying the indicator suite. And of course, there are a lot more indicators in the suite than just the spreads, which means that there's plenty more deep dives to come in the future. In the meantime, stay excellent, team.